Well, good afternoon, financial professionals. My name is Brendan Derone, Chief Distribution Officer for E4, and you are attending the BREW on September 29th, 2021. Hope you're enjoying the end of the third quarter. As fourth quarter comes up, time to finish all your goals for the year. Ends up being our busiest time of the year, and same for our financial advisors out there. So let us know what we can do to help to move your inventory from pending to placed. So, and then start working on 2022 goals. With it being September 29th, we've got our national days. It is National Women's Health and Fitness today. So either get out there yourself or encourage that special someone to get out and enjoy something healthy and fitness-like. It is also National Coffee Day. So have a coffee, get pepped up for that workout. With that, our presenter today, Dan Mythen, Wealth Strategist with E4, is going to present a trip with Tara. So Dan, I'm going to hand it over to you.
Hi all, thanks Brendan. So Tara is something I'm going to introduce you all to that you have seen before. We got together with our associates, John Florence and Bill Anderson, about 6 months ago. And we decided, there's a concept that everyone is familiar with under different names, but there may be different buyers out there now. So let's try to redesign that, take what we know from that concept, what we think the best tools are, and expand upon that. So that's what I'm going to present today. Trip and Tara. Well, let's talk about Tara. Tara is very similar to a LERP or an IBERP, if you're familiar with the carriers that coined those terms. But E4 decided to coin it as Tax Advantage Retirement Account. As you can see on your screen, we have the first page of it. This is a PDF that you can use. We thought it very necessary to really try to make it very clear of how it works, using permanent life insurance to overfund the gross tax deferred. You can pull that money out tax-free if you follow the planning. And then there's always a residual death benefit. So we looked at that and said, okay, let's also go through the features. As you know, these types of concepts have gotten a little bit more complicated as products have changed in 7702. So our attempt is let's keep it as direct as we can, but also allow for different types of planning that occur throughout the road. The features, as you know, no contribution limits, no earned income limits. This is outside of ERISA. It's a lot of different growth options, fixed, indexed, or variable. The assets, as you know, grow tax deferred, and the tax-free retirement income comes out as return of principal, as you know, and loans against the policy. And there are tax-free death benefits for the survivors, of course. Depending on the state that you're in, the TARA can also offer creditor protection. I'm in the state of Washington, and luckily we have that. I believe there's over a dozen states now that allow that. Not necessarily true for other types of retirement assets like 401k. I believe there was a Supreme Court ruling a few years back that kind of pierced that, if you will. Again, tax-free, penalty-free access for long-term care needs. Some of these folks use the rider for a critical illness that we can put on the policy, but others say, hey, here's a pool of tax-free cash that I can use for anything, including long-term care. Something super powerful that we use is, if you use this concept and you do it on a yellow pad, we say divide by the reciprocal. So what that means is if you're going to assume a retirement income of, say, $100,000 from a tax-free account, how much would that equate to in a taxable account? So you divide by the reciprocal. In this example, we use 37%. And that amount came out to, from your 401k or IRA, you would need $158,000. Big question for folks interested in this are where tax is going, and we'll talk about that a little bit later. So that's generally the first page of TARA. To kind of go over those same alternatives and comparisons to the other assets you would use in the retirement account space, we put this grid together. So we compare our Roth IRA, to a non-qualified brokerage account, a deferred annuity, and a qualified retirement plan such as 401k or IRA, and the tax advantage retirement account. As you can see, we look at the pros and cons of each. Tax deductible premiums, or really right now qualified plans is about it. Unlimited contributions, annuities, brokerage accounts, and TARA. I've been working in this market for well over 25 years. And I know that there are some limitations based upon death benefit for this, but I've never seen anybody hit that threshold where the underwriter would say, oh, you're buying too much life insurance, because remember, we're buying as little as possible to drive that cash value with as little drag as possible. Income tax deferred growth of values, we know that's true in these cases. I mentioned creditor protection, favorable estate tax treatment. Little bit of an asterisk here. It's a tax-free death benefit that you can use if you have a taxable estate. What a lot of my high net worth clients, high income clients have done is sell the policy after they pull the cash out to a trust to get it out of the taxable estate. So there's some advanced planning we can do in the later years there. The cons for all these, contribution limits, as you know, for Roth, it's about $7,000 per year, I believe, right now in qualified plans. Earned income limits, as we know. RMDs kick in for the for the qualified plans. And there are penalties across the board, and this is a big one, for everything but the TARA. A lot of folks that need to use this for maybe funding kids' education or emergency purposes that can pull it out as a loan and put it back in. Very flexible there. And you can see, 3 out of 5 are taxable income. So that's TARA in a nutshell. Is really, how do you overfund a policy? What are the pros and cons? Some of the younger folks that I work out with in Seattle that are in their 30s, they have a different buying, process than some of the folks we may have worked with in years past. But we put together some questions you would ask to qualify the type of client, and they would be pre-qualified. But here's some of the better ones that we have used. If you could qualify for a Roth, how much could you commit to funding over the next 5 or 10 years? Now, this is designed for the folks that are making a lot of money, over $184,000 for an individual plus. And they go, I can't qualify for Roth. Even then, it's only $7,000. But what we want to do is make sure that they understand that this isn't something like an annuity or a mutual fund or something where you can only fund it in the first year. You have to put in at least 4 to 5 years, and Steve BREW and some of our folks at E4 will let you know that minimum for the carrier. But we say 5 to 10 years, and they can do all years if they wanted to, but we want that commitment, understanding it is flexible, but we don't want that person in the 3rd year saying, I put 20,000 into this for 3 years and I forget what this thing is. I don't know if I want it anymore. So you have to kind of go over it again. So I think that's important to know up front, what's your commitment. Secondly, what's your expectation of a reasonable rate of return? Why do we ask that? Well, we don't know what the risk tolerance is, and that would lead us to either IUL or VUL or whole life if you wish to go there. Most of the folks I'm finding today with a frothy market is IUL. Seems to be very efficient. The return is the return as we illustrate on the illustration, and VUL for some of the younger folks if they like that risk. This is a big one. Are you expecting any capital events, such as the sale of a business, sale of property, inheritance, or stock award? I would add bonus to that as well. As you know, these can be used in the corporate environment. Bonus plans are a great tool for compensating some of those higher income folks as part of the corporation, and you can add a restricted endorsement agreement or golden handcuffs. Please ask us about that if you have corporate clients. I'm going to point to inheritance. So if we're talking about your 30-year-olds that have young kids and they have an inheritance or a stock award, some of them look at that as, this is later money. This isn't splurge money. Let's take part of this and put it into something that's going to protect our children, our work, our family in the early years, and then provide for retirement in the later years, and then a death benefit. Sometimes I've also seen grandparents setting aside money for the grandkids. So, why grandparents and grandkids get along so well because they have a common enemy. Okay, that's a little estate planning joke. Anyway, here's what I want to talk about where it leads into the trip. So if we're looking at the buying habits of maybe the younger folks that are acquiring things and they have a lot of stock awards, got with the right company at the right time. One of the greatest things, if you do financial planning with them, one of the funnest questions after going through all the dry numbers sometimes with them is, what's your dream purchase in retirement? And get them to dream about that. And what would it be? So that leads us into the trip. And what is a trip? Taxable Retirement Income Planner. And we have this in an Excel spreadsheet that you can access through E4, as well as a lot of more tools around this. So we're going to talk to this person and say, what is your dream purchase? When the kids are through school, you're retired, and what's your retirement date? 50, 55, you pick the number. Well, he and I have always talked about a retirement motorhome. And look at the national parks. That's on our bucket list. Okay, well, what's the cost of that today? Well, for a decent one, it's $150,000, and you all know you can spend a lot more on a motorhome. What's your inflation assumption? What do you think inflation is going to be? So these are all inputs that we put into the Excel spreadsheet, and it really just does the math and said, okay, 150,000 today is 314,000 down the road. And what's your income tax in 30 years? In 20 years, 25 years when you're going to retire is 30%. And what's your retirement growth rate? So we put those in there and we say, okay, we do the math. And I'm going to switch to the spreadsheet here and show you how that kind of all works. All right. I'm assuming everybody can see the spreadsheet. Good. So this is interactive, obviously.
I'll say yes.
Thank you, Brendan. 25 years to retirement. Again, we chose a motorhome. You pick that. What's your dream today? What's the inflation rate? This is a simple, let's change the value here to 30 years, and you'll see how things change. Simply, it goes up from 340 to 364. And here's where we will show at the bottom of that page as a printout is where does that money come from? Are you going to take it from your retirement savings, 401k or a Roth? We didn't put your brokerage account in this. Obviously, you could do that. You could finance it. Right now, I looked up the rates. It's about 6.5% for a big motorhome. What's your choice? It's all taxable if it comes out of the IRA. It's all taxable if it comes out of your 401k. There's no tax if you have enough money in your Roth. And if you take it out of Tara, it's tax-free. You could borrow the money if you wish to. So again, I think it's important to look at the buying habits of the folks that are in this marketplace, identify their risk tolerance, identify how many years they have, what their dream might be, to take them from maybe a current day, I'm acquiring things, stuff through Amazon. My friends are buying a house, a second home, but we have something we want to buy in retirement, and get them to figure out, okay, if I'm going to fund that, there's a big difference in funding it out of a taxable account or a tax-free account. So it's all about taxes. Something else we were going to share on this call was the reconciliation bill. They're still making sausage, so we really don't know what's going to come out of that. But I think 9 out of 10 folks in our business that you speak of, probably more than that now, believe the taxes are going to have to go up, mainly income taxes, which would make this concept, of course, more valuable for clients that want to avoid taxes in the future. So with that, we'll take some questions.
All right. If anyone has questions, now is your chance to ask. I do have a couple people telling me what their dream retirement purchase are, but I don't know that they want to share that with the group. But I found it interesting. More than one person did that. On that proposed tax changes or all things. I mean, not only are there potential changes to just tax rates, but there's some other really concerning things within the bills proposed. And I would advocate, if you're not a NAIFA member, please become one and let them advocate for our business on Capitol Hill, and make sure that we keep some things the way they are, which are beneficial. So, little shout out for NAIFA there. Not seeing any questions. I think we'll close with that. But as always, we have a drawing for today's winner. Dan, would you like to pick a number 1 to 25?
Let's go with 21.
All right. Lori Tandy Wentz is our winner today. So congrats to you. Also, thank you for all attending. Next week, we have our own Doug Twitty from our design team talking about how you can use some of these cash values within your TARA plan even a step further. So we'll tie in nicely. With that, enjoy the rest of your third quarter, the rest of your week, and thanks for being here.